Well, thank you very much for that. It's very kind. And I'm delighted to be back at Western and honored to be asked by President Chakwa to give this inaugural address, the President's Lecture Series. It's a campus I can barely recognize, by the way. I think this used to be where I parked my car, but that was a long time ago. It was a 76 Chevy Impala, I think. But anyway, I'm also really pleased that my longtime friend Paul Booth is here. Paul and I started work at the Banque of Canada on the same day, back in 1981. We're dating ourselves, Paul. We've been collaborators and friends ever since, and now he's doing some really innovative things here at Ivey, the Lawrence Center, which is cool. So, while preparing for today, I did a little reminiscing. I was struck by how prophetic some of the lessons I learned here back in the late 1970s have turned out to be. I'll share a couple of those with you. Many of us came to Western at that time to learn from people Emmett mentioned. Okay, the high-profile duo of David Laidler and Michael Parkin, were these headline names. And I can remember David telling me, and this literally was in 1978. But I remember it well, and I bet he would too. Usually he wraps his knuckles together. I don't know how many of you know him, but anyway, that's what he does. Steve, monetary targets will help keep us out of trouble. But if we do get into trouble, they might not get us out. That was wise. And then there was Michael, who later was my thesis advisor, who said, Steve, there are lots of monetary policy rules that deliver the same inflation outcome. But each of those will have very different consequences for the economy. Well, those words ring very true 35 years later, I can tell you, particularly given our experience over the past decade. And while central banks were diligently maintaining low and stable inflation, we witnessed the emergence of absolutely massive financial imbalances, an unprecedented expansion in leverage, a global financial crisis, and a synchronized downturn in the world economy. So today, as we try to apply the lessons that we learned through all this, we find ourselves weighing a much wider range of consequences in charting the future course of monetary policy. Now, thanks to some deft policy making, the global economy avoided, I would say barely, a second Great Depression. Now, that said, what we call the Great Recession was very painful and still is. More than 6 years after the crisis, emergency monetary policies remain in place in many countries. In short, we're still a long way from home, and the headwinds are very strong. Now, the experience of the past decade makes a pretty strong case, it seems to me, that central banking needs to be reinvented. Keeping inflation on track certainly was not sufficient to keep us out of trouble. Some would even argue that the tranquility fostered by successful inflation targeting helped to spawn the crisis by leading investors and financial intermediaries to take excessive risks. At the very least, it seems to me that we need to take account of a much wider range of economic and financial consequences while targeting low inflation. An evolution of central banking is already underway, supported by recent experience and, of course, new research. And today I hope to inspire economists here and elsewhere to join in. Now, it's worth thinking back to how central banks operated under the gold standard in the 19th and the early 20th centuries. Now, at that time, keeping the financial system stable, in other words, preventing banking panics, that was the primary objective. And under most circumstances, currency could be converted into gold, so the price of gold served as our nominal anchor, a type of inflation rule for the economy. Central banks provided an elastic supply of money, expanding or shrinking the supply to meet demand and maintain the fixed gold price. And the aim of all this was to avoid those wide swings in liquidity and interest rates that often heralded banking crises. Now, the central bank of that era also supported financial stability, as we think of it today, by acting as the lender of last resort, thereby preventing a liquidity shortage in just one bank, becoming a full-blown panic. The Bank of Canada, which, by the way, will celebrate its 80th anniversary in a couple of weeks. We're going to have cupcakes, I'm told. That's 1,300 cupcakes, so that's not a small thing to organize. It was established during the Great Depression with those objectives in mind. But there was also a hint of more ambitious set of objectives, given the state of the economy at the time. The Bank of Canada Act instructed us to regulate credit and currency in the best interests of the economic life of the nation and to protect the external value of the currency. It was pretty silent on about how to accomplish those things. But in the event, the gold standard, which we found ourselves under, proved to be too rigid a framework for monetary policy. And in 1944, the Bretton Woods Conference gave the world a system of pegged but adjustable exchange rates, which replaced the gold standard with a US dollar standard, which in turn, the US dollar was pegged to gold at $35 per ounce. Now this system, to keep the story short, also proved unsatisfactory in several respects. Certainly no need to go into detail, but the stresses of the early 1970s proved too much. The Bretton Woods system collapsed, launching an era of high global inflation and a search for a new framework for monetary policy formulation. Now a number of central banks, including the Bank of Canada, at that time adopted monetary targets as a means of getting inflation back under control. Slow the growth of money, and you slow the rate of inflation with minimal consequences for economic growth. That's how the theory went. Now, this was the state of play when I came to Western in 1978. And there was solid academic support for that policy framework. But by the time I arrived at the Bank of Canada in 1981, only 3 years later, there was growing disenchantment with monetary targeting, mainly because the link between money and inflation was proving to be quite unreliable. So for practical reasons, the target had to be abandoned. But as former Governor Gerald Bowie famously put it in 1983, he said, "We didn't abandon M1, M1 abandoned us." Well, the search for a better monetary policy framework continued through the 1980s, both in central banks and, of course, in academia. And the questions that were being addressed were very fundamental ones, like what is the optimal monetary policy? What's the best anchor for that policy? Should central bankers be bound by rules, or should they be afforded discretion? How much discretion? And as you all know, what emerged from that was a consensus that central banks should pursue inflation targets directly, rather than targeting an intermediate variable such as the money supply. In 1991, the Bank of Canada then became the second central bank after New Zealand, who beat us only by a few months, to adopt inflation targeting. And over the next 10 years, many other major central banks joined the inflation targeting club. Now, at the time, it was hard to argue with the results. Inflation targeting was seen as a key contributor to what we now call the Great Moderation. That's a period of about 15 years of steady economic growth, low and stable inflation in most of the major advanced economies. In Canada and elsewhere, consumers and businesses could make longer-term financial plans with more confidence. Interest rates were lower, economic cycles were more moderate, unemployment was lower and less variable than in the past. So this success contributed to a widespread belief that maintaining low and stable inflation was the best, indeed the only, contribution that a central bank could make to the economy's performance. Countries with dual central bank mandates, that's low inflation and strong growth, or sometimes low unemployment, they could rely on what we call the divine coincidence that said that stable inflation would emerge only when the economy was operating at full capacity anyway. And what about the issue of financial stability? Well, central banks would remain available as lenders of last resort, to be sure, the purpose for which they were originally created. But financial stability issues were seen primarily as a responsibility of regulators, and perhaps a problem for emerging market economies where banking systems were less fully developed. So this policy consensus began to wobble as the financial stability concerns grew during the mid-2000s. By 2007, it had fallen apart. Confidence that keeping inflation low and stable would keep us out of trouble had bred complacency, and complacency bred calamity. Now, we all know the rest of this story. So far, the fallout from the financial crisis has cost the global economy over $10 trillion in lost output. We are discovering just how ineffective our policies can be in getting us out of trouble once in. Now, there's no need to document all the monetary actions that have been deployed since 2008. There's too many. Suffice to say that with interest rates at all-time lows, in some cases even below zero, and massive expansions of some central bank balance sheets, monetary policy is still pushing flat out, and yet still we see a lackluster outcome for the world. Obviously, the headwinds that we're facing are very powerful ones, and they're dissipating only gradually. Now, although we're not out of the woods yet, it's nevertheless, I think, the right time to be thinking about what monetary policy should look like once we are. So I'd like to talk about 4 lessons that have emerged from this experience. So the first lesson of the crisis is that low and stable inflation is a necessary but not sufficient condition for financial stability. The low nominal interest rates that came with low and stable inflation led investors to increase their leverage and risk tolerance in a desire to boost their returns, and similarly encouraged consumers to ramp up their borrowing. We learned that these vulnerabilities can build up over time, raising the risk of a crisis even while the economy looks to be safe and sound. The second lesson is that while imbalances can make an economy vulnerable, debt-fueled imbalances are particularly hazardous. That's because when there's a shock, like the financial crisis, it can take a really long time for balance sheets to be repaired, and the economy simply does not recover in the usual way. A massive price tag for cleaning up the crisis has demonstrated the value of preventing these imbalances from building up in the first place. The third lesson is that maintaining a low and stable inflation rate is a two-edged sword. Yes, there are the expected benefits in terms of efficient functioning of the economy and financial markets, but there's a downside too. The low equilibrium level for nominal interest rates means that central banks have very little room to maneuver when there's a large negative shock, such as the one we encountered in 2008. And being constrained by the effective lower bound for interest rates, 0 or thereabouts, has clearly prolonged the global economy's adjustment. The fourth lesson is that policymakers cannot safeguard domestic financial stability simply by focusing on the safety of their domestic banking system. Policymakers really didn't understand the risks associated with the new forms of financial intermediation, such as complex debt instruments like collateralized debt obligations. And they didn't comprehend how interconnected the global financial system had become, how easily shocks can be amplified and transmitted from one place to another through those channels. Now, responses to some of these lessons are already being put in place. There's considerable supporting research, both at the bank and academia. At the regulatory level, the G20 countries recognize the need to make the countries and the world's financial systems much safer. The Financial Stability Board was given the task of coordinating the development of minimum global standards around capital, liquidity, resolvability, as well as for market infrastructure, such as clearinghouses, to reduce the risk and severity of any future financial crisis. Now, by and large, the FSB has delivered, and countries have begun to implement those new standards. On the monetary policy front, central banks, though, must, at the very least, understand emerging financial stability risks when conducting monetary policy. And all central banks have upgraded their capacity in this area. We at the Bank of Canada now take a much more structured approach to our analysis in our semi-annual Financial System Review, a sister publication to our monetary policy report. Specifically, we use more and much better data to assist our financial system monitoring, backed by deeper conversations and models where appropriate to make more informed judgments about these financial stability risks. And we've added other potential sources of vulnerability to our analysis, such as the balance sheets of households, companies, and banks, to our macroeconomic models. And we're also making progress toward a better understanding of how monetary policy actions influence risk-taking. So, for example, when a central bank cuts interest rates to cushion the economy from a shock, the hope is that people will borrow more at that lower interest rate and spend more money. Well, what this means is that financial imbalances are a necessary byproduct of monetary policy action, especially, of course, if that action is prolonged. So these additional adjustment dynamics must be fully taken into account when conducting policy. Clearly, though, incorporating financial stability into our monetary policy framework is just a work in progress. Now, as a practitioner, it still feels to me like we're adding various rooms onto a house that we love, rather than creating a new, elegant, and coherent structure. We need to make sure that there's enough flexibility and clarity about the role of financial stability in our monetary policy framework, and we need to better understand how macroprudential policies, such as mortgage insurance rules, things like that, that are aimed at promoting financial stability, how they interact with monetary policy. And above all, our experience of these past few years reminds us that, as economists, there's a great deal that we just don't know. Our models, frankly, are simple abstractions, and the notion of uncertainty that we build into them is usually of the benign white noise type that policymakers can generally ignore. I would argue, rather, that the uncertainty that central bankers face is truly fundamental, Knightian in nature and scope. And we run the risk of making major policy errors if we simply assume that uncertainty away. Well, this necessarily transforms monetary policy making from something that we might think of as reverse engineering into an exercise in risk management. So let me touch on some of the known unknowns that are on my mind, speaking as a practitioner. Ideas for further research, if you will. I'll touch on 4. First, there's the globalization of production, by which I mean the optimal geographic distribution of production chains by companies. Now, we see research and development in one country, manufacturing of components in various other countries, final assembly in another. Now, this phenomenon is well documented, but its effect on some of the things we hold dear is not well understood. For example, there is evidence today that fluctuations in global inflation account for a large and growing share of the variation in inflation in individual countries. How does this affect our ability to target domestic inflation? And how does the international rearrangement of manufacturing processes affect the way that monetary policy feeds through the domestic economy? Second, there's traditionally been a reasonably well understood role for exchange rate fluctuations in monetary policy actions and in the equilibration of the economy in response to shocks. Canada, in particular, remains committed to a flexible exchange rate regime. But a growing share of global output is now produced in economies with fixed or heavily managed exchange rates. Plus, as I said, companies have spread their supply chains across multiple countries with multiple exchange rates. So how does all this affect the transmission of monetary policy actions to our economy? The third, there are interesting questions around the impact of changing income distribution on the monetary policy transmission mechanism. Globally, we're in the midst of 2 dramatic waves: a demographic wave, as large numbers of workers in their peak earning years approach retirement, and a technological wave, which is producing structural adjustments in labor markets, especially in the middle of our income distribution. So how do these forces affect the responsiveness of the economy to monetary policy and our ability to maintain low and stable inflation? And fourth, our macroeconomic models are based on the so-called representative firm. a representative firm that reacts to policy changes by, for example, borrowing or hiring and investing more when interest rates are lowered, and less, of course, when they're raised. But we know that smaller firms behave very differently from large firms, and the credit channels that they deal with are not the same at all. In our current situation, where so many firms have simply disappeared, we need to understand these processes very well, because our ultimate recovery from the crisis will depend on a rebuilding process involving high levels of new firm creation. So these are just some of the things on my mind, and they arise just now at the time when the bank prepares to renew its inflation targeting agreement with the government, which is scheduled for 2016. Now, the technical issues directly related to that agreement were laid out in a speech recently by Agathe Cote, my colleague, in November in Calgary. I recommend you take a look at that. It's full of all those details. But I want to mention a couple things here. It should be clear that the lessons of the recent crisis will be coloring that research agenda. As Agathe said in her speech, nothing is broken. And the bar for changes to the inflation targeting agreement will be very high. And in spite of the financial stability issues that have raised today, inflation targeting has served us well, and we remain committed to the concept. As I said at the beginning, there are lots of monetary policy rules with the same inflation outcome, each with different implications for the economy. And what we need to do is to understand these better within an agreed inflation targeting regime. So we've learned that interest rates associated with 2% inflation leave very little room to maneuver in response to large shocks. Further, we know that the so-called neutral real interest rate will be lower in future for demographic reasons in particular, and this will reduce our maneuvering room even further. Together, this could mean a much greater risk in the future of hitting the effective lower bound for interest rates for any given inflation target. So we need to consider the risks of any changes to the current flexible inflation targeting regime, including any possible side effects on policy credibility, very carefully before we make any decisions. So let me conclude with a few thoughts on our current situation. Since the onset of the crisis, central banks, including the Bank of Canada, have been reworking the way they balance risks to financial stability and inflation with their policies. In a discussion paper last year, I tried to detail how we apply this risk management framework using the experience of 2013 and the first half of 2014 as illustration. But in fact, the events of the last 6 months have illustrated these points even more vividly. The bank has been setting policy with a view to balancing the risks facing both the outlook for inflation sustainably to target and the risks to financial stability, such as those posed by indebtedness of Canadian households. The sudden drop in global oil prices has increased both of these policy risks at the same time. First, the oil price shock is an important setback in our progress toward full capacity, full employment, and stable inflation because it is a net negative for Canada's economic growth. And second, because lower oil prices mean lower Canadian incomes across the board, the shock will worsen the debt-to-income ratio for Canadian households, thereby increasing financial stability risks. Now, our decision to lower the policy interest rate last month was intended to take out some insurance against both of these risks. It gives us greater confidence that we can get back to full capacity and stable inflation by the end of 2016 instead of sometime later in 2017. And at the same time, it will cushion the decline in income and employment as well as the rise in the debt-to-income ratio that lower oil prices will bring. Using the term insurance underscores that we are in a very uncertain setting. And what we're really trying to do is to manage the risks we face, not eliminate them. We are not in a position to engineer the perfect outcome. The negative effects of lower oil prices hit the economy right away. And the various positives, more exports because of a stronger U.S. economy and a lower dollar, and more consumption spending as households spend less on fuel. those positives will arrive only gradually, and they are of uncertain size. Plus, the oil price shock itself is of uncertain size. So the downside risk insurance from the interest rate cut buys us some time to see how the economy actually responds. Well, as you can tell, it's a pretty exciting time to be a central banker. Monetary policy making is evolving in real time, and as I've argued, it's deserving of true reinvention. We need to develop a monetary policy framework that integrates inflation risks and financial stability risks, both statically and dynamically, and captures much more accurately the uncertainties that we face. In short, a true synthesis that takes full account of the lessons of the past, both new and old. So let's get to it. Thank you.
Hi, my name's Paul Booth. I am a professor here at Ivey and director of the Lawrence Center. And like the governor, a graduate of Western's great economics program. My job is to moderate a Q&A session. But before I do, I just wanted to say on behalf of everyone here, and especially our dean and the faculty and students of Ivey, thanks so much for coming and sharing your thoughts about the future. And it's great to have you back at Western.
Yeah.
So we have some microphones set up at different parts of the where I'm supposed to be pointing at these, right? Pointing. Is there one on this side or in the middle? Right. Okay. Give a wave there. Great. Okay. And so what I would ask is so that we can maximize the number of questions that and the responses that we have as pithy as possible questions, and we'll leave it to you to decide how pithy you want the answers to be. But I think to start off, we have a question right here. So maybe you can stand up without a microphone and shout it out.
Well, I always enjoy your remarks. One of the things that we have not factored in terms of economic policy, political risk. And I don't know how one deals with political risk, especially political risk emanating out of business.
Well, Surinder, as usually the case, you have a great question, to which I'll just say, next question. No, seriously, next question. I'll just say a word about that. I mean, there's a whole literature now growing around political risk. And I know you know some of it, of course, because of your background. And at EDC, where I was from before, we had a whole group. That's all they did, like 8 or 9, 10 people. And but factoring it in some sort of quantitative way is a very difficult thing. So it ends up being kind of a detailed kind of risk assessment that then you put an overlay on top of the plans you're making. And some political risks, as an investor, you can ignore, and others you can't. For us, primarily, it's an exogenous thing, so it might be like, how do we make an estimate of what the oil price might be like? That would be one obvious manifestation where political risks hit. And the answer is you can analyze that all day long, and you'll say on the one hand and on the other hand. And this is exactly why in our monetary policy report, we just picked the last few weeks, average the price of oil, and we say, that's our assumption. And we'll do a shock, say plus $10 or minus $10, so people get a sense of how our views are sensitive to a political risk outcome. But actually bringing it into your forecast, as a business person, you must. As a forecaster, that's a much harder thing to do. And, I'm sorry if that's not a very complete answer, but it's the one I have for you today. And Paul wants me to be pithy.
I have a question here at the front, and I'm still have people come up here.
Linda?
Interested in your outlook on the EU.
Yes.
We've seen so much environment with such disparate political and economic situations?
That's a great question, Linda. You know, full disclosure. Okay. So, all right. Well, I think Europe is just a perfect case study for what I was talking about at a global level. We've been in this since 2008, and if you took a list of all the things that the U.S. did to get itself out of trouble, and that's where it all started. Now we would say that sunshine is coming, and they're gathering great momentum, and so we can feel it here in Canada. So we're starting to get all that sort of happening. But think about all the things on that list that the U.S. did in the cleanup, and ask how many of those things have already been done in Europe. And the answer is not very many. So that's just to say that the work of extracting yourself from that post-bubble crater is long and hard, and it could take several years longer. The good news is that their financial system appears to be stronger than you might have guessed. The inspection went very well, and that's an important linchpin to the whole recovery story. But the last part of your question is a very interesting one, is when have we ever had a single currency area with that much disparity within it? And the answer is we have it all the time right here in Canada. Canada is just a disparate collection of economies, and we've had a single currency for a very long time. You ask, how does that work? It's because of the kinds of fiscal equalization things and the EI system that stabilizes things and ability to move back and forth and so on. And all those things that give us that fluidity, they're less so, right, in Europe. But that just means that for a given shock, it's harder for them. But we've had a lot of disparity within Canada at times. We have one right now, as you know. But in the past, we've had these shocks where inflation differences would be like, say, 4 percentage points between Ontario and Alberta, that kind of thing, both directions. That's an indication of the need for an exchange rate to adjust if there were one, right? But there isn't one, so the costs of other things have to do the work. So anyway, that's a cute answer to, I think. Anyway, I think it's cute, but it's a cute answer to your question. That's just to say we did that work back before they created the EU, or the Monetary Union, and we said, you know, we've had that in Canada, so it is survivable, but you have to have the right kind of adjustment mechanisms within it. And they have some, but not all the ones that they would need. The outlook is for more of the same, I think, for the time being. It's going to take quite a while for that all to come out. But at least they've managed to muddle through reasonably well, despite everything. So hats off to them. Next.
Over to you.
Oh, up the back.
Hi there.
There we go.
I was just wondering, last year you made some comments about youth unemployment in Canada. I'm sure most of us have probably heard of that. I was wondering if you consider unemployed youth in Canada, which is, I mean, quite a few of us, if you consider them a risk in general.
Well, this is, it's not just Canada. The situation I've described globally is a very common factor, which is that coming out of the recession, those with jobs, most of them manage to keep them, but some lose them, and the new entrants have this frustrating phase when it's hard to break in. And so for us, I mean, there's only so much that one can do in a macro sense. What we're trying to do is get out of that post-crisis phase of adjustment as quickly as we possibly can, and to provide sufficient support for as long as necessary so that new companies are created or companies that get their confidence back, invest, and create new jobs. That phase just seems to be beginning in Canada. In the U.S., we see it a little bit more advanced, and we're following in behind it. So we're quite confident that that natural sequence is underway, and that's a very positive outlook over the next couple of years. So our modeling suggests that in about 2 years, we'll be what we call home, that we'll be back to full capacity. And that should be the case that those who are seeking full-time employment and are having to settle for part-time employment will have been able to make that transition. And those who are entering the labor market for the first time have much better chance to engage. So, I mean, and believe me, I take this very seriously. It's, for us, the labor market capacity is the key indicator that tells us we have a lot of room to grow, and that's why interest rates are as low as they are, so we pave the way as much as we can for companies to grow us back home. Thank you.
All right, thank you.
I have a technology and social question for you.
Okay.
Years ago, about 20 years ago, I was in Singapore, and the Postal Savings Bank there had a chip card which you could download money onto through an ATM and use it. Now, that's pretty old technology now. Now, my question is, why doesn't the Bank of Canada eliminate all currency except electronic currency, as it would be a tracking system that could identify pools of funds that are moved around and basically eliminate a lot of the organized crime and drug trade, which is bigger than most countries, because it would be very difficult to buy drugs without transferring some value to some dealer or organized. Through the computers, you would know exactly where the money came from and went.
Right. Well, that's an interesting question. I don't know if I want to take responsibility for the whole set of problems you just laid out there. In fact, I'm pretty sure I don't.
No, but the central bank is basically a tool of society.
That's right.
And you're an employee of ours as society.
Right.
And hopefully you work with public health and the RCMP and the tax people.
I understand.
And if there's pools of money that seem inappropriate, we could do the Al Capone thing and put a person in jail for tax evasion.
Understood. Well, you know, it's an idea worth considering, I guess. But you know, the vast majority of global payments are electronic. It's actually a very tiny fraction that aren't. I don't know about you, but I've got currency, and I like to have it. That's a good. It's about the surest thing. Have you ever had one of your cards compromised? Yes. Have you had to go through the thing of getting a new debit card because it's been compromised? Yes. So no payments means is perfect.
No,
but you know, there's more than one objective. That's the point I'm trying to make. That we're not trying to satisfy just one objective, which is not an invalid one. It's a good one. But the one that we are most responsible for is the fluid payment system, one that's safe and secure and efficient. And currency evidently still is a really important part of that, not just for those doing black market transactions.
But the Postal Savings Bank card was not a credit card. You downloaded from your ATM.
I understand.
Maybe $200
exactly
or $300. It would be the same as a pickpocket taking your wallet with your money in it.
Yeah.
So you wouldn't lose any more.
Yeah.
But it's a tracking system.
Yeah.
Because
well, I get the idea. Thanks, but I know I've already given you more of an answer than I actually know the answer to. So. That, you know, everybody really wants money in their pocket, even the good guys. So I think that's important that we provide that too.
We have time for two more very pithy questions.
Pithy, okay, and a pithy answer.
Not the answers.
Because this guy here has had his hand up for a really long time. But anyway, go ahead.
Hi, sir. So my question is, given the state of the global economy right now, it seems that every single central bank is trying to lower their interest rates to lower the value of their currency. So how long can we expect this to last? Because this is not a feasible long-term solution where everybody tries to just lower their rates.
Okay.
Is there a long-term solution? That's what I'm trying to ask.
Yes, there is. And so what you see is part of the long-term solution. So you may look at a central bank cutting their interest rate and think, oh, they're just trying to lower their currency. Well, that would be wrong. What they're trying to do is to make sure their inflation rate gets up to their target or their economy grows fast enough to ensure that things are sustainable. And that's the only tool they have. They don't have 4 or 5 to choose from. They only have their interest rate to choose from. And which direction must it go? Down. One of the consequences of that, often, is that the exchange rate will go down at the same time. Agreed. That's part of the normal modeling of the transmission of monetary policy. Now you'd say, well, if it's mainly the exchange rate, then all that does is kind of steal growth from somewhere else. So someone else says, well, now I need to cut my interest rate. People call that competitive devaluation. Okay? And people say next, that's a zero-sum game. Right? You're nodding. Wrong. Because if Because if everybody, let's say the world economy is slower than we hoped, which, you read today's newspaper, that's the conclusion that people are getting. The world economy has been serially disappointing us for several years, and it's doing it again now. So what does that mean? It means that interest rates need to go down everywhere. But we don't all get together and cut them all one day like we did in 2008. That was an emergency. What happens is you watch the developments in your economy, you cut rates, and you watch how it responds. Somebody else cuts rates, and eventually everybody's cut rates. It's not zero sum. It adds up to more growth for the world, pushing against those shocks. So I'd just like you to shift your frame a little, because that's what they're just trying to do their job. They're not trying to devalue themselves out of trouble. Okay?
Thank you.
Thanks.
Second last.
Second last. I just wondered that you said there are the 4 points that we're looking in the future at the economic model. Low oil prices. I don't quite understand that, the negative and the positive.
Right.
I understand the positive, low cost of business or whatever. What's the negative? Is it the revenue that we're getting from Canadian sales? Or is
Yes.
it?
So Canada's a big net exporter of oil. And so when it was $100, people are paying us a lot more for each barrel that we're producing. That income comes into Canada through the oil producers' channel and then gets spent across Canada. So we estimate that during the run-up in oil prices from $25 to about $100, that added about 7 to 8% onto total Canadian income. What has happened right now is close to half of that has been unwound. So it's like Canada is receiving a 3% pay cut. And it happens the day it happens. There's no lag. Okay? It takes a while to spread around, but it's spreading faster now because people commute to Alberta, to work there for 3 weeks and then 1 week off, that kind of thing. So it's happening quite quickly. That pay cut means that consumption spending will be reduced in various parts of the country first and then gradually gets spread. So the guy no longer renovates his house in Calgary, the guy who's going to do that job doesn't buy a new pickup truck, doesn't need the supplies, and so on it goes. That's how it gets spread. It was good for us on the way up in that sense. It's bad for us on the way down. And our analysis is, yes, there are positives. Stronger U.S. growth, stronger global growth. Lower exchange rate would give us a little more export action, that kind of thing. But what's more important is that the negative happens immediately. The other things happen very gradually, and they're of questionable size because the export sector hasn't behaved normally for the last several years, right? Because of destruction of companies and so on. And of course, households, I don't know if you had an extra, say you cost you $30 less per week for your gasoline, do you not automatically spend it? Or if you have a high credit card balance, maybe you just pay down your credit card. So it doesn't necessarily stimulate growth that you have that extra money. Do you see what I mean? Yeah. So for us, it's a net negative. And that's why we had to take some cushion there, some insurance, until we figure out how net negative it actually is. Fair? Thank you.
The honor of the last question.
Thank you, Governor. Today, your address coincides with Chair Yellen's Humphrey Hawkins testimony.
Yes.
In 2012, Chairman Bernanke's Humphrey Hawkins testimony, he gave a list of items that the Fed deemed to be above the bar if the U.S. economy needed to have more accommodation. Given your point number 3 in talking about insurance for the tenant economy, can you please tell us if the Bank of Canada needed to have more insurance and more accommodation, what items would be above the bar as far as additional accommodation or insurance that can take it out, given the zero low advantage?
This guy is too smart to be allowed to ask questions. Okay, I think we're out of time. Briefly, pithily. Not that that's really going to do it justice. But yeah, look, we obviously we have some room to maneuver at this time. When we say insurance, we mean it for real. It's not just, oh, let's call it insurance this time. What I want to try to convey there is that we know we're somewhere in a zone of uncertainty, and the net risk that we perceive to our inflation program is negative. We don't really know how negative it is. So we take out some insurance that's available to us and say, now let's watch things evolve, right? So as that goes on, then those positive and negatives start to work their way out. And we do have a little more firepower if we turn out as needed. But fortunately, we can see, for example, we assumed Brent would stay around, would average $60. Well, it's averaging about $60, so our assumption at least is working not too badly. So that's good. But as we move forward, the question is, well, if, say, there's another crisis or another downturn in the world economy, what next? Well, and everybody's already, they've used up everything they've got. And so then, of course, we know there are other tools that people have used, and they've actually done some good. So the quantitative easing, people make jokes about it all the time, but it worked, okay? And it's not just about getting bond yields down a little bit more. It's forward guidance to kind of compress the yield curve and stuff. Those things have effects on the margin, like really, are you going to borrow a lot more just because you get a few extra basis points? It's not about that. It's about making sure that all that liquidity is there, ready to go, and it's confidence building to know that somebody is actually taking action and getting it done. So in the EU, and monetary union, it's going to be like that. Well, we're taking an action, and business confidence will be stronger just because of that. So all that is to say that you're into the dark zone with your question. I don't have an answer for you like that. But we do have things that we can do, and presumably if something like that were to happen, it would be a shared thing. And so what happened in 2008, it was not just monetary policy. There was a major fiscal effort that happened across the board, every country, everybody did it all at once. It was that combination of fiscal and monetary policy that averted the second Great Depression. Coming out of it now, we're into trying to get the fiscal house back more or less in order, getting the monetary policy with inflation back to normal, and we're all hoping that nothing bad happens along the way. As it looks like the momentum's gathering, so we're quite pleased with how it's going. Hope that gets you for now. Okay, thanks.
Thanks everyone for some great questions and some very pithy answers. And now back to our president to close the proceedings.